In this video, I want to talk about interest rates. There's a feeling out there in the general public where many people have heard that the Federal Reserve has cut interest rates. And there's this hope and optimism that by the Fed cutting interest rates, their credit cards will become cheaper to pay, or it may be less expensive to borrow money for that car, or to buy that house, or buy that boat, whatever they're looking to borrow money on. And that's the furthest thing from reality. The Federal Reserve does not have the ability or power to set rates when it comes to many of the loans that we get as consumers. They set an overnight lending rate in which financial institutions borrow money overnight. Now, they do have some powers when it comes to liquidity. That's how much debt is available or how much debt is issued. But our government for the last 50 plus years has had a ravenous appetite for issuing debt. They need inflation. I used to trade bonds, and the general conception is that bonds were safer than stocks. That's not true, because you have quite a few elements involved in a bond. You have price, rate, the ability to pay. These are all things that affect how bonds trade. For example, if you have a bond trading at par value, let's say $1,000, and the interest rate is, if everything stayed the same, you give your $1,000, you'd get back 5% on that bond. The bond would be paid off from whatever term it was paid off, and you're back to even. But it doesn't work that way. That bond then gets bought and sold many times over. During the duration of that bond, what happens is that bond may only be worth $990. Well, if the price goes down on the bond, what happens is that 5%, because the price went down, it's now not 5% of 1,000. As the price goes down, the yield or the percent goes up, and vice versa. If the price of the bond were to go up here, then the yield on the bond would go down. So they have an inverse relationship of how they work. Well, how does this relate to my credit card or my car payment or anything like that? The Fed Reserve is out there cutting rates. It's got to be a good thing. Well, that's not entirely true, because the Fed typically follows what the 2-year note is. If you were to go back and look at some charts and you look at what the 2-year note is from the federal government, let's say it's at 4.5%. Usually within a half or a 1/4% is where that Fed overnight rate is, rate in which the Fed's set. And that, like I said, that rate, now that 2-year rate determined. You got to realize that the bond market is at least 10 times larger than the stock market is. A lot of people say that your smart money are in the bonds, and your not so smart money's in stocks. But if you looked at the amount of money, the amount of dollars in circulations in the bond market, it is 10 times that of stocks. So if you have $1,000 and you get 5%, that's not a lot of money. If you have $1 trillion and it's at 5% or it goes to 5.5%, that's a lot bigger number because of the size of the pool of dollars. Just because the Fed is setting that overnight lending rate has nothing to do on a mortgage. A mortgage is typically tied to a 10-year bond somewhere. It could be here in the United States. It could go off the 10-year bond. Well, what sets that 10-year bond is the bond market. What someone is willing to pay for that bond is, are they willing to pay $10,000 and get a 5.5% return? If the federal government is adding $1 trillion of debt every 90 days to its balance sheet, and it's not making any more income. It's in fact, tax receipts, or what they're collecting on taxes, is going down, and transactions are going down. Their ability to pay is not nearly as good as what it may have been 2 years ago, 3 years ago. So when that auction comes up and people want to bid on those 10-year bonds, instead of them transacting at $1,000 a piece, maybe they go for $950 or $900. What's happening now is there's something called a tail. A tail is when there's an auction for bonds. Your banks are most of the bidders that bid on these. There's private equity groups, there's hedge funds, there's governments that go out there and purchase these bonds. Blocks of bonds that go out for auction. Let's say, make it simple, let's say there's 100. Well, the first 10 go out at a certain price, the next 10 go out at a certain price, and then all the way up, and they get to those last 10, the market has kind of been supply and demand. People don't want them as much. So there are institutions that have to buy bonds. They literally have to buy what the government is issuing. So they say, well, we bought some at $950. We're not going to pay $950 anymore. Nobody else wants them, so we're only going to pay $900 for them. So the difference between what the first bonds sold for and what the last bonds, the difference in rate, meaning if the rate has gone up from the low part of that yield to the high part, that's called a tail. So all those bonds in that lot, if there was 100 of them, will all get the same yield, the same rate as what the cheapest ones got. So if it goes off at 5.5 or 6%, and that tail is that big, then they all are at 5.5 or 6%. So really, the reason I'm giving you that story is it's kind of, we've had in the last bond auctionings the largest tails we've ever seen on those auctions, meaning that the appetite or the people that want these bonds is not as good as it used to be. It causes rates to go up, and that auction processes, those are what control. I gave you the example of the 10-year. The 10-year is most associated with what home prices are. So if you looked at what mortgage rates are, you can go look at a 10-year. Let's say a mortgage company is going to originate that loan. They're going to charge you some fees. They can get money at, let's say, 5.5 or 6%. Well, they got to make money on top of it. Typically, it's 2.25% they add on top of it. Let's say 5.5 or 6% is now 7.5 to 8% is what you end up getting it for. So that's how that works. Car loans, depending on the duration, you can look at a 1 year or a 2 year bond, or what the market will bear. A lot of times is, and your credit score, your ability to pay, has a big determining factor on what rates will be, because it's just like when the government goes to auction bonds to raise money to run the government. There, people are evaluating what's the ability of the federal government to pay their debts. So when you go to apply for a loan, and whatever your credit score is, someone's evaluating you the same way. What's your ability to pay? Am I going to get this money back, is the question they're asking. That's the same thing that large financial institutions, countries, going back historically, with wars, conflicts. If we go back to 2008, I do a whole history class on this, is that, China bought a lot of U.S. bonds and helped us out a lot back in the mid and late 2000s. Now, we have decided to change our view on how we transact and do business with them, and whether they are a threat or friendly. They don't want our debt nearly as much as they used to. Japan was another country. Japan bought a lot of our debt. Our government would issue bonds, and you'd have foreign countries holding bonds, basically debt. They were making money off it, and we were glad to do business with them. And that's, in this big scheme of finance that we are, dollars or the U.S. dollar doesn't take a rocket scientist to figure out that what you could pay for with a dollar 100 years ago to what you can pay for it now is drastically been reduced, and that's inflation. The Fed's, one of the Fed mandates is, they say keep inflation at 2% or 2.5%. You're like, well, why do we need any inflation? Why should we have inflation? With technology and innovation, shouldn't things become cheaper? But again, if you're borrowing all your money, you need to have inflation, because inflation generates more revenue. If there was deflation on products being sold, the tax revenue base certainly would not go up. But that's a whole nother topic. But again, what this video is about interest rates and understanding that it's not controlled 100% by the Federal Reserve. They have one small little screwdriver, or hammer, or whatever you want to call it. And if you go back and look at that little hammer or screwdriver or tweaking mechanism they have, is usually pretty predictable. Looking at that 2-year note of what it's doing is a good indication of where they're headed with it. So in essence, they follow what the bond market is telling them. A lot of times you want to look at what the bond market tells you a lot. It gives you signals, it gives indications of what's coming, what's happening. It's a very good indicator. It looks as though we're probably in an environment where we're going to have higher rates and higher inflation for longer. After World War II till really 2020, 2022, we were in a environment where the rates were going down. I mean, you go back in the late 70s, I think they peaked out in 1980. You had high double digit interest rates. I remember my father bought a pickup, and I think he paid like 18% interest on a pickup truck one time. Some of the guys I've worked with over the years would tell me stories about buying houses, and they were paying 12, 13, 14, 15% interest. So we're not there yet. It's going to be a very interesting ride to see what happens going forward. Like, subscribe, give me some comments. I'm going to do deeper dives on all this. I am working on putting together some courses, and eventually one of these days I'm going to write a book about it. Thanks for watching, and I'll see you on the next one.